Great. Welcome, everyone, to Mayor Brown's 2025 edition of 20F Readiness. I'm Jason Parsont, a partner in Mayor Brown's New York office. My practice focuses on, among other things, public company capital raising and disclosure obligations. I'm joined today by my colleagues Brian Hirshberg, Tom Kollar, and Gilat Abraham Zaefen. Why don't you each take the mic for just a brief introduction before we begin? Brian?
Thanks, Jason. So like Jason, I'm also based in our New York office here at Mayor Brown, focusing on capital markets transactions for foreign private issuers, both on a registered basis, so IPOs, other type strategic transaction, de-SPAC transactions and the like, and also unregistered transaction, private placements, 144A transactions, Reg S transactions, and all sorts of other kind of cross-border type capital raises. So glad to be here with you. Tom, pass it off to you.
Thanks, Brian. My name is Tom Kollar. I'm a partner in a Hong Kong office focusing on the U.S. capital markets practice across Asia. Here in Asia, we act for both U.S. registrants and non-registrants alike on the full spectrum of DCM and ECM products. Thanks, Brian.
Hi, everyone. I'm Gilat Abraham. I'm an associate in the New York office of Mayor Brown, focusing on capital raising and public company work. It's good to be here, and I'm passing it back to Jason.
Terrific. Thank you all. So just before we get started, a few housekeeping items. So we're offering CLE credit to those seeking it for today's session, and we'll read the CLE code aloud when it appears throughout the presentation. The CLE forms can be found at the bottom of the connection details email, which was sent to you yesterday, along with instructions on how to complete and return them to the Mayor Brown CLE team. Should you have questions during the presentation, feel free to enter them into the chat box and we'll do our best to answer. We'll circulate a copy of the materials in the coming days via email. So with that, let's get going. The purpose of today's session is to help you get organized and hopefully give you some really important insights into the process for this year. This way you can efficiently prepare and refresh the disclosures in your 20F annual report. This year, you'll be happy to note there's less in the way of new rules to worry about than in some recent years, and some that you've heard about have been stayed or vacated in light of legal challenges or even just abandoned post-election. And we'll touch on this. As you know, the new Trump administration takes over beginning next week. So you can expect that the regulatory priorities of the SEC are going to change, but we have no concrete guidance on exactly how. We mainly know the personalities and what's been said in general. To start, President-elect Trump nominated Paul Atkins to replace Gary Gensler as the chairman of the SEC. Atkins is widely respected. He served as commissioner for many years, and he worked at the SEC during both Democratic and Republican administrations. One thing we know about him is that he's been critical of the SEC at times for meddling in free markets. And this criticism has included the mandatory climate change disclosure and other rules that are viewed as raising costs for public companies and investors. So we're probably safe in predicting that the SEC's climate change release, which was stayed last April, will not come back to life in the near term. But as we'll discuss, this doesn't affect other existing rules that you still need to think about regarding climate change and mitigation strategies and how all that affects your business. There are other trends that accompany the new administration as well. So you've seen in the headlines, including just this morning, announcements that a number of companies are retreating from DE&I. Others are not. If this does affect your company, you may need to think about how you're going to revise your human capital management disclosure. You need to make sure that it all syncs up with your company's policies. So we'll cover topics like this as we go, but overall, the agenda you're going to see is generally in accord with the SEC's priorities currently as they are today, as if nothing had changed. Until we know specific things are going to change, we want to prepare you as if they haven't. So you can see on the screen today's agenda. So I'm going to kick it off by discussing some hot button disclosure topics, including cybersecurity, climate change, and artificial intelligence. I'll also cover how to think about refreshing your risk factors in the new report. I'll then turn it over to Brian to discuss some topical issues related to the new insider trading rules, the beneficial ownership table, and an update on clawbacks of executive compensation. From there, Gilat and I will cover refreshment of your MD&A, including some thoughts around the SEC's guidance on KPIs and non-GAAP financial measures, which continue, to be important from a comment perspective. We'll then turn the mic over to Tom. Tom will discuss the SEC's focus on China-related matters, including the continuing relevance of the Holding Foreign Companies Accountable Act and the Uyghur Forced Labor Prevention Act. I'll then cover the status of the SEC's recent attempts to remove accommodations for foreign private issuers, thinking about this, of course, in the context of the new administration and how some of this might change. And finally, before taking questions, Gilat will discuss some considerations for your D&O questionnaires and the new EDGAR Next system for filing your 20F. All right, great. So you could flip the slide, Caitlin. We'll start with cybersecurity. So most of you now have one cycle of cybersecurity disclosure under your belt. Terrific. The new rules went into effect for fiscal years ending in December 2023. Unlike last year, we now have more market-based precedents to observe. But stay aware that we can't simply borrow disclosure. The staff has been very clear that it wants disclosure tailored to your actual practices. Disclosures are required in annual reports on Form 20F and in some cases on Form 6K for material cybersecurity incidents. But we're only going to focus here on the annual reporting disclosure requirements. The chart that you can see on the screen provides a high-level reminder about the disclosure rules on cybersecurity, which should now be familiar to you from last year. The first major category is around the processes you use to identify, assess, and manage cybersecurity threats. The second and third are around governance, how these processes are overseen. So last year, you would have form checked to ensure compliance with the new rules. You would have checked cybersecurity disclosures on your corporate website, in press releases, your earnings, elsewhere to ensure consistency with your SEC disclosures. And you would have solidified the infrastructure to back up that disclosure, including establishing disclosure controls and procedures among responsible stakeholders who you would have hired or appointed. The balancing act, as you'll remember, is providing sufficient detail to inform investors of the risks to the company while avoiding details that could increase the company's vulnerability to an attack. So this year, do that again, but also do a market check against a few peers to ensure you're disclosing at a consistent level of detail and to see where the practices of others differ. It's a fine-tuning kind of exercise. For example, with respect to risk management strategy and processes, most disclosure last year, now that we have a year under our belt, was referencing certain things, right? So do you have these things? Conducting risk assessments, access management, logging and monitoring, penetration testing, vulnerability scanning, threat intelligence, employee awareness and training, security monitoring, audits, and tabletop exercises. You'll see a lot of these keywords common to a lot of the disclosure. It's also been common to note use of an external cybersecurity framework. Okay, so if you're already doing that, great. Most companies use third parties to assist with these kinds of processes and disclose that they conduct due diligence and undertake monitoring or auditing to address cybersecurity risks from using third-party service providers. So far, the audit committee or another committee of the board most often has responsibility for cybersecurity oversight, with the full board remaining responsible for the general enterprise risk management processes into which cybersecurity oversight is integrated. With respect to management's role, most are naming one or two officers with responsibility, typically including the CISO, right, the Chief Information Security Officer, and they cite that person's experience before joining the company, their years of experience, and to some extent, any relevant degrees or certifications. You do not need to disclose, by the way, director expertise in the field. There's mixed practice on this last requirement, which is to describe whether any risk from cybersecurity threats, this is the key phrase, including as a result of any previous cybersecurity incidents, have materially affected or reasonably likely to materially affect the registrant. So your disclosure here will be very specific to your situation. If your company experienced a previous cybersecurity incident, give careful thought this year to the right approach to disclosure, especially in light of the recent lessons we can learn from the SEC's October 2024 settlement, which we're going to talk about in a minute, with 4 current and former public companies that experienced the software hack known as the SolarWinds Orion hack in 2020. And the SEC's December 2024 settlement just happened with Flagstar Financial in connection with a 2021 Citrix breach. You could change the slide for a nice summary of these lessons. So even though, right, these attacks occurred years before the new rules came into place, the lessons remind us of a few things that we think are still relevant, right now. First, even though the company is a victim of the cyber hack, it's important not to minimize known incidents in public disclosure. So one example where the SEC got focused in an enforcement action was there was a company that described a hacker as having a, quote, limited number of email messages, but it was actually more substantial than they let on. There was 145 files, which I guess the SEC didn't think was limited. Okay, so just be cautious there. Second, do not describe cybersecurity risks as hypothetical or discuss them just generically, despite knowing of actual intrusions into a company's data. So for example, last month's Flagstar action said the attacks may compromise sensitive customer data when it was known that personally identifiable information, PII, of 1.5 million individuals was compromised. This is a lesson not just for cybersecurity risks, but for all risk factors where risk actually materialize. Just remember, half-truths in a 20F remain actionable. A deficiency like this could call into question the reliability of your disclosure controls and procedures generally. And as a result, and especially when they do, they can come with really hefty fines. So, these actions were ranging from, on the one end, around 4 million to on the lower end, closer to 1 million. All right, so let's
And
see.
Jason, I would just add before we turn the topic, we do get a number of questions about insurance. A number of clients have cybersecurity insurance, and some include that in their disclosures as well. But those half-truths or those deficient disclosures are going to be read by your insurance carriers as well. And you could potentially be in the situation where you get a claim denial if you haven't been following or putting out accurate disclosure. So think about it from that insurance perspective too.
Excellent. Thank you, Brian. So Caitlin, you can go to the next slide. So some lessons can also be gleaned from reviewing SEC comment letters and the latest CNDIs. A few examples of where the SEC has given comments concern these topics that you see on the slide. So the first is requiring better explanation of how the process for identifying risks has been integrated in overall risk management. So for example, one company said its internal audit used a, quote, comprehensive and layered auditing approach to evaluate the effectiveness of existing controls and, quote, ensure that cybersecurity risk has been adequately mitigated. Sounds great, but the SEC made the comment that you have to require future filings to explain how this approach is integrated into the company's overall risk management system or processes. So, they weren't connecting it to general enterprise risk at the board level. Other failures identified internal inconsistencies in the use of third parties. and failures to make required disclosures about management expertise. So, generally form checking and consistency checking. Hopefully these lessons will help avoid comments for you in this year's 20F. So I'm going to move to climate change. Just one last point, though, before I do. There's a quick reminder that inline XBLR tagging of this disclosure, cyber disclosure, will be required for the first time this year for both annual disclosures and any incident reporting you do on 6K. Okay, great. So let's now turn to climate change. Okay, so as is well known to you by now, the final SEC rules that were approved last March were subsequently stayed pending the resolution of legal challenges. And President-elect Trump's choice to lead the SEC, Paul Atkins, as I noted at the beginning, has been a vocal critic of the SEC's climate change disclosure rules. So it's possible these rules may be repealed in the near future. But I just want to remind you that it doesn't mean you can just ignore this as a disclosure topic. The SEC's 2010 guidance on climate change and the 2021 sample comment letter remain in place, until we hear further, right? And these touch on how existing SEC disclosure requirements apply to business or legal developments relating to climate change. So you should still be form checking against this. You probably did this in prior years, but just refreshing. Keeping in mind, investors still expect to see disclosure of material risks to the business relating to the physical impacts of climate change and any indirect consequences of climate change regulation on your business. Plus, your company may already be subject to, or may become subject to, other climate disclosure requirements in your local jurisdiction or other jurisdictions, like what we know is in the EU and in California. So take a look at what you already have, see if it needs a refresh. Keep in mind that the SEC can and does compare climate-related statements outside of SEC filings, including if you have a corporate social responsibility report or a sustainability report. They're comparing that, right, with the statements in your SEC filings. And if there are discrepancies, you could get a comment about that. Consider also when you're drafting MD&A, are there plans or costs for climate change mitigation strategies, that you should be talking about. Also, be mindful of the potential for allegations of greenwashing, right? This is the phrase that means false or misleading statements about a product's environmental benefit. Make sure that any statements about sustainability and meeting your goals are supported, supportable, and accurate. As with all disclosures in your 20F, half-truths are actionable, so be sure you aren't cherry-picking only the positives without also giving any relevant negatives. So we can now move to artificial intelligence. Okay, great. So AI, as we know, became last year's buzzword du jour and will likely stay in the spotlight for some time to come. There's been a steady uptick in companies mentioning AI in their periodic reports, so it's been on the SEC's radar. It's mostly focused on risks, but may also be found in business descriptions and/or operating and financial results and prospects. The staff has been regularly highlighting AI as a disclosure priority, so companies should be thinking about how the use of artificial intelligence and the risks related to that use are required to be disclosed this year. And just like greenwashing, there's now the concept of AI washing, right? Same idea, false or misleading claims about what AI is going to mean for your business or prospects. In March 2024, the SEC settled charges for AI washing against 2 investment advisors using the anti-fraud provisions of the federal securities laws in connection with their AI disclosures. For example, one falsely stated that it used a predictive algorithmic model for asset selection and deployed machine learning to analyze the collective data shared by its members to make intelligent investment decisions. Okay, so think about this as a lesson. The SEC is encouraging companies to make appropriate disclosure about AI. So look at what you're saying to investors. What are you saying on your earnings calls, right? Make sure what you're saying is consistent with what you're saying in your SEC filings. If you talk about AI, explain what technologies you're talking about, because AI can mean different things in different settings. Any statement has to be supportable. You need to have a basis for your claims. So just a few takeaways on this. First, be clear and accurate as to what you use AI for and what you do not use it for. Avoid using hypothetical language for actual AI practices. Understand and accurately disclose the risks associated with your AI use. Define AI internally and for marketing purpose so you don't misrepresent it. And don't merely repeat vendor claims about the AI systems you're buying unless you take appropriate steps to verify them. Okay, so with that, let's move on to risk factors. Great. All right, so here, there's no change to the requirements for risk factors, but as always, the rule is to disclose the material factors that make an investment in your company speculative or risky. The staff will remind folks every year that these need to be tailored to your company. Importantly, as we just said with the recent cybersecurity settlements, your risk should not be phrased as hypothetical if it's something that actually happened. For the upcoming annual report, you should take a look at the whole set of factors. See if these risk factors are getting stale. See if any new topics need to be added. Let's go to the next slide because I have a short list here of a few in particular that the SEC's either mentioned or we think you should just consider generally. So some new risk factors might be around artificial intelligence, like what we just discussed. The staff mentioned commercial real estate. So if this affects you, for example, banks and other entities with significant commercial real estate exposure, right, might be subject to several risks like heightened vacancy rates or elevated interest rates, extended loan maturities, increased loan delinquencies. So just keep that in mind if that applies to you. There may be new risks that affect your business from the administration's new legislative and regulatory priorities. And as we said, we don't necessarily know how those are going to shake out, but we've heard things. For example, we've heard a lot about potential tariffs. Tariffs could be inflationary and could lead to interest rates stagnating or increasing, which would also impact bond yields. While a lot is still unknown, and you can disclose that, right? You have reason to believe a likely policy will affect your business. In that case, you're going to want to put investors on notice. So think about it. For companies with particular exposure to import jurisdictions like China, tariff risks may come in a different flavor. So you'll have to think about that a little differently. It'll also be important to refresh risk factors most of you likely already have around cybersecurity, particularly for consistency with your other cyber disclosure, climate change, right, like we talked about, continuing effects of inflation and interest rate risks, continuing effects of international conflicts on your business. And if you have people or operations in LA, you may need to revise your natural disaster risk factors to move away from anything purely hypothetical or generic if you've actually been impacted by the wildfires. So with that, I'll turn it to Brian to talk about insider trading disclosures.
Thanks, Jason. So for those less familiar, a couple years ago in December of 22, the SEC adopted several important amendments to Rule 10b5-1 under the Exchange Act. So the amendments did a couple of things. First, they added new conditions to the availability of the affirmative defense to insider trading liability contained in 10b5-1. This was meant to address concerns about the rules of abuse by insiders that trade securities on the basis of material non-public information, or MNPI. Second, what I'll focus on here for FPIs is the enhanced public disclosure required by issuers and insiders of trading plans designed to comply with 10b5-1, so-called 10b5-1 plans. Prior to the amendments that are now effective, there were no disclosure requirements concerning the adoption, termination, or use of 10b5-1 plans by issuers or insiders, and issuers were not required to disclose their insider trading policies or procedures. The amendments added new annual disclosure requirements specifically to 20F, So public companies are required, FPIs are required to disclose whether they have adopted insider trading policies and procedures reasonably designed to promote compliance with insider trading laws. So companies that have adopted such policies are required to file them as exhibits to their Form 20-F. As noted on the slide here, making the policies available on the company's website or otherwise publicly posting them in some form is not sufficient for disclosure compliance. However, if a company has not adopted such policies, the form is going to require you to disclose why the issuer has not done so. So the FPI needs to disclose also the adoption of a 10b5-1 plan if it's material. So including all the material terms. So think the timing of the trades and the number of shares, the price, along with whatever conditions apply to that plan. The SEC here is very focused on any amendments or modifications, terminations, any manipulation of 10b5-1 plans is going to come with a lot of scrutiny. Be prepared for that. But the rules of play here are the same as they are for U.S. domestic issuers. As Jason will talk about later, this is an area where, you didn't see those accommodations that very often are extended to FPIs. But the disclosures here, which again are going to be in the 20-F, mirror what domestic issuers are going to have to do in their 10Ks. Next slide. So moving on to the beneficial ownership table. A year after the insider trading 10b5-1 amendments, the SEC then in October of 23 adopted new amendments to the Schedule 13Gs and Ds. So as a reminder, 13D and G of the Exchange Act require an investor who beneficially owns more than 5% of a covered class of equity securities to publicly file either a D or G, which is a beneficial ownership form. Foreign private issuers filing Gs and Ds must comply again with the same general rules as U.S. issuers. However, foreign investors, face additional considerations with respect to their home country compliance. If that particular issue is dual listed, there could be other considerations with respect to what the listing requirements are for that foreign jurisdiction. So there's additional thinking that needs to be done there. Previously, before the amendments, filers were required to report any change of amendments within 45 days of the year end, as noted on the slide here. Now, filers are only required to file for material changes to the information that was previously reported. So those amendments are now required to be filed within 45 days after quarter end instead of year end. So as a consequence, what we'll see practically is a lot of institutional holders that may have filed their 13Gs at the beginning of the year, very often in January or February. They may not be filing 13Gs this year if there's not new changes to disclose, if there's not any material changes to be made, or they may have already filed their 13G in the fourth quarter of last year or earlier when that material change did take place. So, be mindful of that. So essentially what the amendments did here was shorten the filing deadlines to 45 days after the calendar quarter. And it changed the quarterly filing deadlines for those who acquire more than 5% of the FPI securities during that period. The SEC also revised the definition of passive investor for purposes of 13G filings. So now the focus is much more on the intent and actions regarding what the companies control, what the investor's intent with respect to the acquisition of those shares are with respect to the company. Next slide. Yes, so clawbacks. So this will be the second year that we have disclosure with respect to clawbacks. These rules also came into effect the year before last. So this was in June of 23. The SEC adopted the new clawback listing standards that were proposed by both of the stock exchanges. Listed companies had until, as noted, December of 23 to adopt a compliant clawback plan policy. So to comply with the adopted rules, recovery under a clawback policy must be the amount of incentive compensation that is shown to have been paid by the FPI in error. So this is as a result of an accounting restatement that's necessary to correct a material error of a financial reporting requirement. So this is Rule 10D1. So 10D1 requires the recovery policy to apply to any accounting restatement to correct not only an error in previously issued financial statements that's material, so a so-called big R restatement, but also an error that would result in a material misstatement if the error were corrected in the current period or left uncorrected, so called a little r restatement. So if a current or even a former executive officer receives incentive-based compensation in error within the 3 fiscal years preceding the date of determination, then and a restatement is required, then the company is required to recover that excess incentive-based compensation on a no-fault basis. So for FPIs, this presents several unique challenges as it essentially extends the period of potential liability and impacts historic accounting practices. So with very few exceptions, this applies to all listed companies, including those who have different home country governance accounting standards, including those that aren't using GAAP, right? So very important to know who the new policy covers as well. It's not just limited to those named executive officers. It's not just limited to the CEO, CFO. It is much broader. It covers any officer. And for this purpose, the rule that 10D1 defines executive officer as the company's president, principal financial officer, accounting officer, and any officer who performs a policy-making function. Officers of the company's parent or subsidiary, so both up and down, will be deemed to be executive officers of the company if they perform those policy functions for the issuer. So very important to understand who this covers. The SEC kind of modeled the officer definition off of Section 16. Most FPIs don't have to worry about Section 16, obviously. So this is kind of a new internal control, focus that companies will have to be mindful of. FPIs, unlike domestic issuers, are going to have to separately analyze whether the recoupment as required by the exchange could violate home country law, right? Obviously, most FPIs are incorporated outside the United States, so they're going to face challenges in reconciling these new requirements with their local laws, especially in jurisdictions that already have restrictions on compensation recovery. Some countries might not allow clawbacks or impose significant limitations on the amount that can be recovered. So FPIs are going to have to navigate fairly complex legal issues in kind of cross-border type situations. Companies should also assess whether they need any new controls, procedures to track compensation of former executive officers that may be subject to the clawback under these new standards. Maintaining current contact information for former executive officers whose exec comp may now be subject to recruitment is very important. Next slide. So if a company already has a clawback policy in place that was not designed to be compliant, it's going to have to determine whether an amendment and restatement of the pre-existing policy to add the provisions need to be done, because this policy is going to have to be publicly filed, if it hasn't already been done, to the 20F filing this year. So on a go-forward basis, incentive-based compensation arrangements for executive officers, so think employment agreements, they need to include not just an acknowledgement, but consent from the employees, from those individuals, that acknowledging the clawback policy and acknowledging that the recruitment, when required by the listing standards and the company's policies, may be applicable. So we should get those acknowledgements from all of those officers at the time that they're engaged, or at the time that the new updated policy went into effect. So as a result of these rules, again, there's no accommodations here that like we're used to for FPIs. So they're going to face the same potential increased scrutiny that U.S. Issuers face, as well as by the investor community, who will be, focusing on these policies because they're all publicly out there, including, ISS and other different bodies that act on behalf of the investor community. Final point here before I turn it back over to Jason, relatedly to clawbacks, we've now had 2 full years of pay versus performance disclosures that are out there. Now, while this doesn't, it isn't required to be addressed by FPIs, it's certainly worth looking at peer company or competitor company disclosures to see how you line up. As Jason mentioned with respect to the other disclosures, now that we have a couple years of this, it's important to kind of see with those companies that you benchmark yourself against, if they are domestic companies and they're disclosing these pay versus performance disclosures in a certain way, it may be useful for you to review those disclosures to either conform your own practices to that, even though the disclosure requirements aren't applicable, or at least to be mindful of it. So with that, I'll pass the baton back to Jason for our next topic.
Okay, so let me actually turn it to Gilat, if that's all right, to talk about MD&A refresh.
Thanks, Jason. So nothing really new here, but MD&A continues to be a focus area for the SEC. So we wanted to briefly touch upon some of the main common area. And just as a reminder, the primary theme driving your disclosures in the MD&A should be to portray the company to investors through management's eyes. So let's go over some key areas of focus for the SEC. The first one here is results of operations. In recent years, the SEC has emphasized the importance of detailed analysis of factors driving changes in financial statements, line items, rather than simply repeating the numbers. It's important that you work closely with the teams within your company, the business team, the finance team, to explain the factors underlying the reasons for period over period changes and to quantify those changes. We also wanted to remind you the importance of discussing known trends and uncertainties that are reasonably expected to impact near and long-term results. So this is actually, this is a principles-based disclosure. So it's important to tailor it to the specific company, the specific business. So for example, if increased tariffs would be expected to have an oversized impact on your business, you may want to consider adding this to this year's 20F. Another area of focus for the SEC is liquidity and capital resources. So you should discuss your company's ability to meet its liquidity needs. And again, it depends on the specific circumstances. So for example, if your company has a negative operating cash flows, you should probably discuss your plans to fund operations in the short term and also your plans for remediation. Discuss trends, demands, commitments, events, uncertainties that are reasonably likely to materially affect liquidity or capital resources, both in the short and the long term. The next point is critical accounting estimates. So this was actually named by the staff as a focus point for 2025. And even if the staff priorities shift under the new administration, we think that you should continue to focus on judgments made in the application of accounting policies, as well as their sensitivity to change. The staff has been clear that you should not simply repeat the information in the notes to the financial statements. You should supplement them. You should provide greater insight into your financial results. And one area where we saw comments last year was revenue recognition. Segment reporting, here we wanted to remind you that in November 2023, the FASB has made certain amendments to the rules, which would apply to FPIs reporting in US GAAP. So if this applies to you, make sure that you discuss the new rules with your accounting team. I now turn it back to Jason to discuss the last point on the slide, metrics used to assess performance.
Okay, great. And if you could just change the slide there, Caitlin. Okay, great. So the SEC continues to keep a focus on the misleading use of key performance indicators or KPIs. So in this section, we provide just a general reminder that could be useful in refreshing your KPI disclosure. So KPIs, just a reminder, have been described by the SEC as a limited set of critical variables which present the, quote, pulse of the business. The KPIs we're focused on here are the metrics that are not governed by GAAP and that also fall outside of the definition of a, quote, non-GAAP financial measure, which I'm going to come back to. Examples of these types of KPIs include things like operating margin, same-store sales, sales per square foot, total customers or subscribers, average revenue per user, and there's a whole bunch of other examples that were described in the SEC's 2020 interpretive guidance on KPIs, if you want to, see whether yours qualifies. Make sure to form check your KPIs against that guidance. If the company uses a certain metric in the management of the business, the staff will expect a discussion of that metric in line with the requirements of SK 303, and they might request more information if discussion's lacking. KPIs are required under SK 303 under the kind of like general clause of, quote, such other information that the registrant believes to be necessary to an understanding of its financial condition, et cetera, et cetera. The guidance reminds each registrant that includes KPIs in their disclosure that the registrant needs to include such further information, if any, as may be necessary in order to make the presentation of the metric in light of the circumstances under which presented not misleading. So the typical 10b5 type standard. And this is, again, a reminder about the importance of avoiding half-truths. So you can go to the next slide here. Okay. The SEC generally expects a KPI to be accompanied by the following disclosure: clear definition of the metric and how it's calculated, statement indicating the reasons why the metric provides useful information to investors, and a statement indicating how management uses the metric in managing or monitoring the performance of the business. And the registrant should also consider whether there are estimates or assumptions underlying the metrics or its calculation, and whether disclosure is necessary so that the metric is not misleading. Okay, we can go to the next slide. So if a company changes the calculation method or presentation from one period to another, it should consider disclosing, to the extent material, these different items that are in the slide. So the differences in the way the metric's calculated, reasons for the change, effects of the change on amounts or other info being disclosed or previously reported, other differences in methodology and results that would reasonably be expected to be relevant to an understanding of the company's performance or prospects. So depending on significance, it may be necessary to recast prior metrics to conform to the current presentation. To avoid or minimize SEC comments, the disclosure should provide a clear picture of what KPIs are used by management and provide the required disclosure for the periods presented. Okay, so you can go to the next slide. So we're now going to very briefly do a non-GAAP refresh. So, you know, your non-GAAP metrics may themselves be KPIs, right? And by the way, non-IFRS measures are non-GAAP measures, right? So think about it as a special category, because if you're within the definition of a non-GAAP financial measure, there's now governance also by Reg G, SK 10E, and the non-GAAP C&DIs. So as part of your refresh, make sure to form check your non-GAAP metrics against this guidance. In recent years, the staff has significantly increased its focus on ensuring compliance with the presentation and disclosure requirements for the use of non-GAAP financial measures. So this is a general reminder that could be useful in refreshing them. The non-GAAP metrics have two main components. So they're financial metrics, not operating metrics. And they adjust a comparable GAAP line item from the income statement, balance sheet, or cash flow statement by adjusting through an inclusion to a GAAP number or an exclusion from a GAAP line item. And by operating metrics, like operating metrics which are outside the definition or probably your KPIs, they're focused on processes and operations that drive results as opposed to the financial metrics which reflect the results themselves in the financial statements. All public companies are prohibited from presenting non-GAAP financial measures in ways that are misleading, including giving them equal or greater prominence to the comparable GAAP metric. The prohibitions apply to both the order of presentation and the degree of emphasis. As you know well, a quantitative reconciliation is also required to the directly comparable GAAP measure. And much like KPIs, you have to explain the reasons management believes non-GAAP metrics provide useful information to investors. So if you flip to the next slide, these are just a few reminders of the general focus areas where the SEC has paid particular attention. So misleading revenue recognition, equal or greater prominence, and smoothing. So we've put into the slides some of the CD&Is to focus on. So just again, make sure to form check against these. Let me now turn it to Tom to discuss China-related matters.
Great, thank you. So there are three main areas of disclosure focused by the SEC with respect to China-based companies that are SEC registrants, and there's over 200, so there are actually quite a few. The three areas revolve around one, the Holding Foreign Companies Accountable Act, which was rulemaking implemented by the first Trump administration. The PRC government involvement. The SEC is looking for heightened disclosure around any Chinese government involvement with respect to the company. And finally, the Uyghur Forced Labor Prevention Act. So these three areas are the main disclosure focuses for Chinese listed companies. Now, the actual disclosure requirements haven't changed since last year, but recently, as of June 2024, by the former director of corporate finance, they had indicated that the SEC would continue to focus on these topics. And so we would expect, given that they're originally most of it Trump initiatives, that the new administration would stay the course and not deviate from that statement. So we would expect that the SEC and the new administration would continue to focus on these three main areas of disclosure requirements for your 20F filings. Next slide, please. So just as a refresher, what we'll do is just run through what those disclosure requirements are. So first off, for the Holding Foreign Companies Accountable Act, PRC companies, which are identified by the SEC, known as Commission Identified Issuers, need to comply with the submission of certain disclosure requirements under the Act for each year in which they're identified. And there are four main disclosure items which need to be adhered to. First off, the registrant needs to disclose the percentage of shares which is owned by foreign government entities. Second, the government entities in the foreign jurisdictions have a controlling financial interest with respect to that issuer. Thirdly, you need to identify all Chinese Communist Party officials who are on the board of the issuer or the operating entity of the issuer. And finally, you have to identify whether or not the issuer's articles of incorporation contain any charter of the Chinese Communist Party. You may also recall, and it got a lot of publicity, that the Holding Foreign Companies Accountable Act also included a PCAOB inspection right for U.S. registrants that are based in China. So effectively, the PCAOB should be able to go in and examine the books and records of any SEC registrant. The Chinese version of the SEC, which is the CSRC, had blocked that. Blocked PCAOB accounting firms from those inspection rights. It has since allowed PCAOB inspections as of 2 years ago. The SEC was satisfied with those PCAOB inspections that took place during that time. So there's slight detente between the SEC and the CSRC. However, that's not necessarily a disclosure requirement, but I just wanted to raise that because that received a lot of publicity 2 years ago and also 1 year ago when those actions were being taken place by the PCAOB in Hong Kong. Next slide, please. The other disclosure area, which we just wanted to refresh for you, is any PRC government involvement with respect to the issuer. So here, and this was actually recently emphasized a few months ago, the disclosure is to be specific and prominent disclosure about the material risks related to the role of the government, of the PRC in the operations of any China-based company. You also need to include disclosure about any material impacts that the intervention or control by the PRC in the operation of these companies has or may have on the business or value of securities. And the definition of controls, as you know, is quite broad under the U.S. federal security laws. And not only is it direct and indirect power or cause of direction of the management policies of a person, whether by ownership or voting securities by contract or otherwise. The or otherwise is a very broad concept, the subject of much debate. And that really is a very broad definition, so you have to pay attention to that. Next slide, please. Last but not least, your 20F needs to include disclosures with respect to the UFLPA. So in 2021, the government implemented the Uyghur Forced Labor Prevention Act. What it does, it prohibits the imports of goods from the Xinjiang Uyghur Autonomous Region of the PRC. The SEC is looking for tailored discussion about the material impacts of this. You'll see in the news, in government releases, a lot of focus on goods that potentially could be manufactured in this region of China. Many companies that are well known are in the spotlight for this currently. And the disclosure needs to revolve around any of that kind of involvement, in particular, any impact that could include material compliance risks, supply chain disruptions, et cetera. So, these are, 3 main areas that are in focus for Chinese registrants. We expect that focus to continue with the new administration. Although there's no new disclosure changes, you just need to be aware that they're still, on the radar of the SEC and something that you need to be mindful of when preparing your report this year. Thank you.
Great. We could move to accommodations. So this will just take a minute. So you can go to the next slide. So as you probably know well, there's a long-standing bipartisan approach to largely deferring to the disclosures made by FPIs pursuant to their home country reporting requirements. But there's been a little bit of a shift of approach over the last few years where foreign issuers are now being treated just like U.S. domestic issuers. Some of the successful ones we've highlighted: cybersecurity, the clawback rules. Brian touched upon the new cooling off period for directors and officers of FPIs who rely on 10b5-1 affirmative defense for their 10b5-1 plans. But some good news, some of which, by the way, applies to domestic issuers as well, is all the hubbub about the repurchase rule last year. And as well the climate change rule, both of those are stayed on account of legal challenges. And that's true for domestics too. It's not just FPIs. There was also a Senate proposal to subject FPIs to Section 16, much like domestic issuers, but that appears to be a dead letter as well. So with that, I'll turn it to Gilat to close out the last couple of items.
Thanks, Jason. So DNO questionnaires, it's that time of the year again. Most of you are probably already working on the questionnaires, but we wanted to suggest a few updates that you may want to consider. The first one relates to the previous discussion. You may want to add a question together, information about director expertise, especially in key areas such as cybersecurity and AI. And especially if those are material to your company's operations. The second point, the SEC recently took action against a director who failed to disclose close friendship with company executive, which affected their independence. So you should ensure that your questions cover and capture this type of relationship to avoid any misstatements regarding independence. Lastly, in light of another SEC settlement from this year, make sure that you also request information on any margin loans, pledges of companies' securities, and similar arrangements. Next slide, please. So EDGAR Next would be our last topic for the day. In September 2024, the SEC adopted changes to EDGAR, filer access, and account management to change the way filers access and manage their information on EDGAR. The EDGAR access codes will eventually be eliminated, and you will use EDGAR Next for all your filings. So timeline, March 24, 2025, enrollment begins. You will need to use your EDGAR codes to enroll on the EDGAR Next dashboard. September 15, 2025, all filers will be required to use EDGAR Next dashboard for filings, and the access code, the legacy access code, will remain active just for enrollment purposes. And by December 19, 2025, all legacy EDGAR codes will be deactivated. So you will need to request and apply for new codes to access EDGAR at this point. Immediate steps. So you should make sure, of course, that your EDGAR access codes are handy. You will need those in order to enroll in EDGAR Next. And if you use financial printers, you may want to reach out and discuss the best way to handle the EDGAR Next transition. At this point, you can already think and decide who you will designate as your authorized account administrators. These are individuals that are authorized to manage your EDGAR account and submit filings on your behalf. Each of them will need to obtain their own login credentials through login.com. And the authorized individuals may include employees of financial printers. At this point, you can already log into the beta testing environment. You will need to use the actual login credentials that you obtain on login.com, but make sure you don't share any confidential or sensitive information in the beta testing environment. With that, we conclude our session, and we now open up the floor for any questions. I don't know if we have time for that.
Received a question that I can go ahead and ask. You've mentioned tariffs and other popular risks several times during the presentation. Using tariffs as an example, since the risk has not yet materialized, what advice would you give to a company evaluating whether to include a potential risk in its risk factors versus the MD&A? And additionally, what degree of materialization would be relevant for deciding whether to include it in the 20F at all?
I can jump in on that one. So look, tariff policy is still merely theoretical, but there are a lot of unknowns about it. But we can learn from looking at, for example, Trump risk factors from 2017 and Biden risk factors from 2021 to see how other proposed policies were handled in both the risk factors and MD&A sections. For example, in 2017, REITs were very concerned that Trump's tax reform might reduce or eliminate REIT tax benefits. Didn't actually happen, but REITs nonetheless disclosed the risks, since this could have a significant increased tax burden for them. And likewise with Biden, when he came into office, he supported substantial new regulations and policies to address climate change and other environmental laws. So for some companies, this meant disclosing the risk of like potentially large new capital expenditures in order to be in compliance. So if you're worried about tariffs, right? Like, or even, a war with Denmark or Panama, you can look at examples like this to appropriately tailor, these kinds of risks to your situation. And if there are known trends or uncertainties, think about MD&A disclosures on these topics, which might also be appropriate. Happy to take any other questions, and you can also email them to us afterward. We'd be happy to speak further. Okay, great. Well, with that, we really thank you very much for your time today. Hope this was productive for you. Have a great day.
Thank you.